Hi Warriors, welcome viewers at investing.com. This is Face. This is our platform. Beautiful, isn't it? A lot of hard work has gone into this. You have everything, access on one page for everything, your update history, alert history. Could even design your own little Twitter panel here. Okay, so really, besides your platform for trading, there's nowhere else you really need to go. You get all the looks, pattern and play here. Greg is actually trying to bottom pick this. You know, I'm with him on it. Okay, so silver made a new low by a penny yesterday, and gold held previous lows by $4. I think it could come out of the hole here. And one of the major reasons is I been giving decent clues on dollar direction all week. Monday started off down here, said we could rally from the 78.6 level. Then I played it for a pullback through Euro on turnaround Tuesday. Then yesterday when I was talking, we were here. I said this dollar is not giving up the ghost easy, that it could project here. You know, this double top could be vulnerable, but I look at it from right here, right now. And this could be a failing rally. And it kind of fits for a 92 target. This was a 180 point decline. And if we had 1.618 of this, it would take it down to 92. So 180 times 1.618 is about almost 300 points from near 95, gives you 92. That's been the long talked about target, but it has to start reversing here pretty soon. Otherwise, we're just going to blow through 95.50 and take all these stops are. But I like the risk reward here in case we're going to get something like this or a fib extension of this from here. Everyone with me? Was it worth the wait, Oscar? We have a great guest today, Jim Welsh. I've followed Jim's letter and his research for, gosh, almost 30 years now. And he was one of the few that called the top in the Euro up near 123, 125. We were all looking for one more high. So he was there. He's going to be presenting today covering, I believe, Euro, Dixie, bonds, and gold. So I have a great interview by a market veteran who, you know, has been heard on every financial media out there. And he also has a pretty good offer for his newsletter. I read it every week. So stick around for Jim. So I'm thinking that if the dollar's going to fail, it's got to start failing here pretty soon. And S&Ps are getting almost everything back that we dropped yesterday. Okay. So I'm still thinking we have to clear out the bears over this high, 2,800. 1.272 is 28.17. But I just want to show you there are exceptions to the rule in a strong market. One of the sectors, since we're on investing.com today, I'm sure, you know, there are a lot of stock players, ETF players, and just want to show you the semiconductors, which aren't even close to making new highs. We'll see how much of a recovery they have, but this would be its second lower high. Okay, so NASDAQ was making a new high here when we had a failing rally in the semis, and we've had, you know, huge recoveries where S&Ps have taken out this high, an analogous high, and NASDAQ has challenged it. And also the NASDAQ, just to show you which one I think is going to lead. So I think the semiconductors are toast, sell-all rallies, but just to show you something, sometimes retracements tell you about which is leading the way and which is not. So the S&Ps yesterday Well, on that little pullback, only got to back to the 78.6 retrace of this. But look at NASDAQ. NASDAQ actually went deeper to 61.8. So NASDAQ's acting weaker. And really, it's been the star performer. So the star performer's acting weaker, and within the NASDAQ, the semiconductors are showing relative weakness. So that's my analysis for today. I encourage everyone, especially later in the week, to try a trial, at least for $1, and get used to navigating this. You know, one of the you know, all of this, the website's great, but the key to any company is its people, right? It's so, you know, if I go back to home, here's your trial. Also, if you're not satisfied with your broker, contact Forest Park FX. But really, it's about the team. So a lot of people know Blake. Blake is a money manager for one of the elite funds in the U.S. Greg keeps winning awards for his analysis on FX Street. Stelios is one of the best fundamental and macro traders I've seen. I've seen quite a few. Steve is one of the most disciplined traders and really kind of the brains between the revamp of the website. Did a great job. And Steve really waits for confirmations, very patient guy. Dale Pinkert interrupts people during his interview and during the talk session. So just have patience with him. Amanda's in our member chat. She runs a very productive community when she's there. And she's a great trader and puts out all her stuff. Joe Perry is now a regular contributor on Bloomberg to cover currencies. So some people call it the dream team. Andre does excellent harmonic work. You could see his stream and his posts. I always retweet Andre's stuff. He has his own service too. Give it a shot. And that's a pretty good team. So that's really what's behind all the research and what's behind, you know, we blog, you know, Stelios just wrote an excellent blog based upon what's happening in the UK with Brexit, etc. Blake does a great week ahead video to prep you for this. And okay, so I turned on the, I hope I'm still in the webinar. Let's see.
You are. You
are. I am. All right. Anyway, what a great team. Okay, I mean, I think it's the best combination of talent in one spot, collaborating with each other in the community on the net. But I guess you'll say I'm subjective because I'm part of it. So Stelios is here, and I think he has some things to say about some funny developments in Europe before we go to Blake. What's happening, Stel?
Hello everybody. Just a couple of things I wanted to mention. First of all, the European Commission today cut the Eurozone growth forecasts. So they cut, I think, this year's forecast to 2.1% from 2.3%. And Germany and France both were revised lower. And the main reason behind that was, surprise, surprise, because of growing trade tensions with the US. Growth theoretically should be, should take a hit on the back of that. The other interesting thing is actually in the UK, we have Donald Trump's official visit there. Spoke to Theresa May, I think, already. There have been a few headlines coming out of that. The main ones I took away was Trump actually said that he kind of appeared to question her strategy in terms of Brexit, because you know how Trump is. He's very black or white, and what May's government is trying to do now, or they are trying to do it, is basically do a maneuver towards a very soft Brexit. But on the other hand, Trump did say that they agree on immigration policy. It shouldn't be a big surprise, because I think most people will agree that Brexit was actually happened mostly due to immigration, issues. So, we're getting a few headlines there. The interesting thing is that, if you recall, on Monday, it was all turmoil in the UK, and people were making bets how many days May was still going to be prime minister. It all seems to have quieted down for the moment. The big threat, as always, is for there to be enough MPs to question her leadership, and then to bring a vote of no confidence, and then all hell could break loose. But it looks like Theresa May has played her cards, and she's still there. Things seem to have stabilized a little bit. So overall, for people who read my blog post that I posted with Blake the other day, now, I think if this thing sticks, what they're trying to do, it should be positive for the UK. It's clearly not what the English people voted for with the Brexit vote, but still, I have to look at the fundamentals. I have to look at what's happening, and for the pound, the way things have gone in the past few days. Okay, we've had a little bit of political turmoil, but if this sticks, I think it's going to be positive.
Stel, can I just ask you one question? Any news on Trump making a move on May?
Yeah, that's
the warning sign is Tic Tacs. If you see him throwing some Tic Tacs in its mouth.
He only goes for
oh yeah, I forgot. It's not his type. Okay.
And the other thing which I wanted just to barely touch on, to quickly touch upon, is this this really big sell-off in commodities again that we had over the past couple of days. And it is partly justified because we have this escalation of trade wars. Trump announced another 200 billion of tariffs on China. This cannot be good for world growth, that's for sure. So commodities will take a hit. On the other hand, a big part of this is also due to dollar strength. So the last couple of days, the dollar has just been flying, and that I personally fail to understand. I really don't get it. I see the US fighting with pretty much everybody in the world in various shapes and forms, and still people thinking that the dollar is a safe haven, and that's the one you want to own. I find it very difficult to agree with that. It's and what happens if you're the US and you start putting on tariffs for China, EU, everybody? What's going to happen? Well, people are going to kind of start bypassing you. So I'm very skeptical about this dollar bounce, and I really think, well, I'm already short dollar Norway, which is a little bit underwater, but it's a volatile pair. But I will be looking for opportunities to short other dollar pairs like dollar yen and whatever else looks good. So
dollar yen.
Yeah, not yet. Hi,
the dollar, that thing is breaking the hell out today.
I know. I said not yet, but yeah, I agree with you. Yeah.
Yeah, and good morning, guys.
Hey, Blake.
Hey, the dollar yen, and just so you guys know, I got stopped out of a dollar yen short. Pretty good position. I'd been short, ever since we were up at this AB equals CD. I was short, right around my cost average was just around 111, a little lower than 111. It's like 110, like 90 something. And I got stopped out yesterday on the move above 111.50. And I bought it last night at 111.92, I want to say, in Asian trade, and then I sold it in Asian trade at like 112.25 before I went to bed, and it's obviously continued higher since then. But man, this dollar yen is extremely strong. I mean, big momentum.
Well, that's a pro move. I just want to point out to people that are with us today, Blake. Very few people could take a loss, even if it's well managed, and then reverse and go with the direction of a breakout. When you're there, that you've broken some of the old you know, a rookie-ish type of things, because what most people do is, oh, I got burnt in the yen, I'm not trading that for a while. Ever hear of that?
Yeah. Oh, yeah. I mean, it would, and you know what, Dale? Frankly, that's not something I typically will do, but it was such a big breakout. I mean, you know, like this has been a.
I've seen you do it quite a few times this last year and a half or so.
That's probably because when I do it, I'm trading against some big trend line that I know that if it breaks, it's going to go the other way, and that's what happened. And that's so, Stelios, when you're talking about shorting the dollar yen, it's like, man, I can't even imagine doing it, unless we dip back below 111.40, and that's because that was the breakout point. And today we have some pretty important data coming out, don't we, Stel?
Yes, we have CPI today. Yeah, I mean, when I said I want to short dollar yen, obviously not at this level, but you know, I look at much longer term charts, and I think anywhere above, I actually had that 114 level roughly in mind to start looking at it.
There's something, if we could get a hold of Andre, I saw a tweet during the week that the yen was in some type of harmonic. I'm not sure if it was a Gartley pattern that was going to complete or something. Anyway,
well,
I don't see.
If you look longer term, you want to talk Gartley pattern, you know, and do something like this. We're talking about like 120s.
I see.
You know, wow. I mean, you know, we could really head up towards, you know, 122. I mean, I don't necessarily think we're going up there. I mean, but I'm showing you, you know, longer term potential of the dollar yen. I mean, this is breaking out, and this type of move here, Stelios, really is a very scary move, because it's so big. And actually, I was just reading
what does it mean, Blake? I mean, you know, the yuan's been. Do you think that they're letting this happen, want it to happen, embracing it, just like the Chinese have been depreciating the yuan because everyone wants any edge possible in this trade friction?
That's how you combat a trade war. You want to go after the U.S. And you know, you weaken your currencies. And I look at this and I think, man. And I wanted to mention that I was reading a bank report this morning that was saying if you associate the yen with risk on, risk off, you need to rethink that strategy now. What we've seen this last week, and I'm not sure if you guys noticed this, is that, and this is the last week and a half because I've been short the dollar yen, is that it didn't matter if stocks were going down, the dollar yen was not. And you know, yesterday the stock market didn't really do much, and the dollar yen broke out. And I'll tell you, these yen pairs look like they can go a lot higher, and it may have nothing to do with risk appetite or risk aversion. And Stelios, I don't know if I read that this morning, excuse me, and I thought that was a really interesting take on the yen, and maybe because of the dynamics of the trade war, things might be a little different moving forward.
Yeah, I mean, you're right, and like you said, the correlations are broken down, so it's difficult to actually gauge where you know, for example, the dollar yen is going to go. You know, I've been looking at stocks versus that, and it's just not following the usual correlation that we see. So you know, it's just one of the currencies that I have on my radar to go when I short the dollar. But it's going to depend on how it goes for the next, you know, 10, 12, 15, 20 sessions, because it's not just the price, as you know, it's also how it gets there.
Right, and it doesn't, and it's not a, where are my dollar CNH? Oh, there it is. It's not, there's so many more. I don't think it's as black and white as it was because of this trade war that's currently developing. And I think you got to pay attention now to, you know, the the yuan and the the renminbi or whatever however you want to reference it. And but the one thing that I am noticing though is that we are really weak. Gold's really weak here, and that would coincide with a weaker yen as well. So, and gold's really on a very critical level support. If we break, you can see I have an alarm set for this 1237 level. If it breaks, I don't know where gold's going. Gold could, trade down below 1200 on a push lower. So, I think some very interesting developments here.
Absolutely, and the gold and silver have had a pretty good correlation with the yuan. So as the yuan appreciates, precious metals go up. And like our friend Majed says on the, I can see a question. He says, he says, shouldn't the trade war make gold as a safe haven? Now, I think it should. Theoretically, it should, but in practice, short-term moves can be very unpredictable. And like you said, we're sitting on this trend line, huge trend line. If that goes, then we're going to probably see the low 1200s.
Yeah,
so,
I mean, your stops are going to be triggered. You're going to see a lot of selling, and where that takes gold is anybody's guess. But we've had a really big failure up here at the 1350 level. Now here in a few minutes we do have inflation data coming out. We have CPI. Obviously PPI was higher yesterday, and do you think it's going to make its way into the consumer at the consumer level this early in the game? I think it's going to eventually trickle into the consumer, and I think prices are going to really start ramping up soon. What do you think, Stelios?
Yeah, like you said, it should eventually. I'm not sure if it's going to be this print, but the other thing we have to remember is the dollar has strengthened over the, since the beginning of the year. Really, it had a terrible second half to 2017 and January and a little bit of February. I think it was selling off, but then it started rallying, and this strength, dollar strength, will eventually come into the inflation readings if it persists. So that should put the brakes a little bit on CPI. But to answer your question for today's number, possibly it should it could feed through to that. But I think inflation in the US is probably stabilizing now. I don't think we should see a big move one way or another. This roughly 3% CPI. Although the core PCE is the number that the Fed looks at, and that's 2%, 2.1 or whatever it is. I think
2.3 actually, I think.
Okay.
Yeah, and obviously the headline number, Stelio, is almost 3%, and we're saying that without anybody sweating, but it doesn't make much sense, does it?
No, you're right, but we have to remember what the actual CPI number includes and what it doesn't include. We've talked about this many times. So
yeah. But what I'm trying to say is that the Fed has, the Fed initially was looking at the headline number, then and it had an inflation target of less than 2%. Then they actually pinned the inflation target to 2%. Then they started talking about having a symmetrical target of 2%, which in essence means, okay, we spend some time below it, so why not spend some time above it? While at the same time, several years ago, we switched from looking at the headline number to looking at the core number, like excluding food and fuel makes any sense. I mean, aren't those very basic needs for any human being? I mean, aren't they actually eroding the disposable income of any consumer? They are, right?
Yeah. And even core CPI year on year, it's 2.3% or 2.something%. So even that's exactly above. Yeah, you're right. I think the Fed, probably the worry they might have is that they've been hiking, and eventually these hikes are going to feed into the economy, and because it doesn't come from one month to the next. They've been hiking for a year and a half now, so that eventually is going to feed through, and maybe they don't want to go too quickly. Who knows what they're thinking, but bottom line is they're continuing to hike.
If you look at how they've been draining their balance sheet, they've been taking an awful lot of liquidity out of the market. I mean, they're ahead of schedule.
Yeah, so that's the tightening, without
that's
actually raising
more
rates.
than rates. That's, you know, taking liquidity out of the market.
Yeah.
They're selling into it. So
I have a question for all of you guys, Blake, Stelio,
I have one for you, Steve. You weren't at the meeting yesterday, so we all decided that we each get to take a penalty kick against you.
Okay. Okay.
All right? You're in the
Sounds fair.
goal, man.
So I have a question for you. Let's make the following assumption, and let me remind you that this is something that has happened in the past, like 30, 40 years ago. But let's make an assumption that at some point the US economy and the global economy goes in a recession. That's actually not an assumption, that's a certainty. I mean, economic cycles were always here and they will always remain here. At some point, we're going to go to the next recession. But let's assume that we're going in the next recession and inflation is sticky and above target. Which of the two do you think that the Fed is going to try to fight? Is it going to try to fight the weak economy or the high inflation? What do you think?
Well, the thing is, what's the mandate? So the mandate is to keep inflation within a certain level. There's no mandate on economic growth.
They have a mandate on inflation and on employment.
Yes.
But my personal assumption is that they're going to completely ignore inflation and target for political reasons the economy, and with whatever that means, having to do with the path of inflation after that and the path of the dollar. That's my personal point of view. I don't know what you think, guys.
I agree, and it would depend on what the other parts of the economy are doing. But yes, I agree that this is going to become more and more important for them.
Yeah, I don't know. I think they'll still target inflation. I think they're going to remain relatively, they're not going to worry about the stock market so much, but or growth as much. You know.
Let's see.
Yeah, I mean, I do think that they'll make sure that they tame inflation more than anything. It may be to the detriment of growth. As long as employment's not, completely cattywampus, that would be my thought. But anyway, hey, I've got to get to trading the CPI. Steve, good, glad you're here, and we have to. I have to note, and I know you're going to talk about it, is gold, and we were just talking about a moment ago, but man, gold is really, really walking a fine line here. And I think if inflation comes in, the number comes in hot, the risk is that gold could come breaking this level of support. So unless it actually turns into an inflation hedge.
Theoretically speaking, it's an inflation hedge. The weird thing, Blake, is that gold has been very heavy and it's not behaving well. And how do we know that? It's going lower, even though real rates are going lower, which is counterintuitive. I mean, we haven't seen that behavior many times. So something is keeping gold down, and being long looks like a bad proposition. I said yesterday as well that unless we close above 1260. We have to respect the potential for more downside. And as you showed, we are currently testing trendline support. Anyhow, let's have a look at the inflation data, and then we'll have Gregor with us. So we'll also have Gregor's viewpoint on several stuff. I think Gregor is already with us, actually. So we're going to.
Good luck, guys.
Good luck, mate.
You too, Blake.
See you later.
I'm
Bye-bye.
with Gregor. Gregor likes it here for a C wave recovery, I think, up towards 1260.
Let's see. Greg is going to tell us. Let's have a look. I'm going to have gold open here. We're going to have
a dollar play right now, Steve.
We're going to have
dollars Kona 92, gold will bounce. That's my, my opinion.
USD yen, by the way, is testing the 78.6 Dale fib of the last move lower from the November high to the March low. So, Stelio, let us know once we get the data. I think we should be only a few seconds away, right?
Yes, T-minus 10. So we have CPI, and we also have jobless claims, but that's going to pale in.
I think that's secondary, yeah.
Yes. So let's have a look. 0.2 core CPI month on month, 2.3 year on year. CPI 0.1 versus 0.2, marginally weaker. core CPI is
marginally
exactly in
weaker
line.
indeed.
Yeah.
Gold's
And
pop.
jobless claims,
Yeah. And initial claims 214 versus 225.
but the revision was not. The revision was higher, and continuing claims is higher. So overall, I think not much.
A little bit weaker data, actually. Yeah. Nothing to write home about. And we also had Canada May new housing price index 0.0 versus 0.1 month-on-month expected. So far, we're not seeing any big reaction across the board. We have here in the middle top, we have Euro USD. On the right of it is cable. Below it is USD yen. We have gold here in the middle. At the bottom, so far nothing really to write home about. The market doesn't seem to be reacting to the news. I mean, USD yen seems like it's literally stuck.
Dollar reversing a little bit here on the Dixie.
Let's have a look at the
right from where it has to for us to get to 92. So it's got, at least it starts here. I like shorts with stops above 50. That this could be a failing rally, Steve. Maybe we get
it can. We might,
1 point equality, or 1.618 takes it to 92.
Yeah, we might get something like this, Dale. Something like this.
Yeah, that's what I'm thinking.
Okay. Yeah, that's likely. Gregor?
I won't be sure about anything till I hear Gregor.
Hey.
I can't be sure about anything until I see your charts. Yeah.
Yeah.
Yeah, you're my confirmation tool.
To be honest, this summer is really tough. I mean, it's up now.
It is.
Really, if you just take a look, euro dollar, where it's the most traded currency pair, and it's had this for the last 2 months almost. So it means we are in the middle of summer for sure.
It's not only that it's summer with a World Cup, Gregor. It's even worse than that.
Oh, congratulations on your neighbor winning, Greg.
So maybe they're really tough guys, those Croatian players. So
yeah.
I would.
Oh yeah, they are. And you know something, Gregor.
Yes.
You know something, Gregor. I was looking at the odds yesterday. The market was really underestimating the chance of Croatia to going through, which in my opinion was a bad bet, a really bad bet. I mean, just to give you an idea, you would get 4 times your money in advance of the match if Croatia actually won during the regular duration of the game, which was completely overblown in my opinion. And you know, the problem, and many didn't realize, is the fact that England has a very, very weak midfield, and that's where Croatia won, because they actually cut the English team in 2. I mean, they could only transfer the ball from defense to the offense by high lobs and high balls, simply because they couldn't go through Modric and Rakitic in the midfield.
Yeah.
Yes, and probably their goalkeeper had more ball in his legs than any other player. Like they were always playing England with the goalkeeper to the back.
Yeah. So and you know, the other thing is that it was obvious that they were the weaker team, because they were trying, actually, after scoring in the 5th minute from the foul, they were just, you know, it was obvious. They did that with Colombia as well. They were trying to make it through the rest of the game.
Yeah.
Make it through the rest of the game just by stalling.
They went on defense. Yeah. They went on defense. Yeah.
Yeah, exactly.
It was also their speculation when they were playing with Belgium, because they want to move into the next round into the weaker part.
But anyhow, I think that Croatia, and you know, even by seeing the stats after the game, I think that Croatia absolutely, fair and square. I mean, they were the better team in the field. They passed. But I do think that this English team, you know, it's a young team. If they get a couple of central midfielders, in the future that are of higher quality, like for example, yesterday they were playing like with a central defender as a defensive midfielder, and the Henderson is, in my opinion, is too slow. So if they get a Gerrard or you know, or a Lampard equivalent in the future in the team, I think they're going to be doing fine. But you know, they're not there yet. Anyhow,
All right,
let's go back to the
let's see
markets.
what Greg has. And one last thing, Greg, do you play at all, or did you when you were younger? Soccer?
Yes,
Okay.
I'm actually playing it just as for hobby, but yes,
okay. Anyway, you get a free shot, a penalty shot against Steve because he missed the meeting yesterday. We all get to take a shot at him. All right.
Okay, let's go back to the market. So, despite of having these awful conditions to trade, which is, yeah, it's objective, what do you think is, you know, what are the cleanest setups out there? I mean,
the cleanest setups is clearly long dollar at the moment, and I'm looking several pairs now. I will just start with the euro dollar since I have it here. So last time I spoke about these potential head and shoulders unfolding. We also moved to very nicely to the downside, actually below this 2017 trend line, where price recently found resistance. So I still favor the idea that we are here consolidating for a triangle. Okay, so if I show you this chart for our chart, so I'm looking for an A, B, C, D, E pattern. So it's a sideways movement structured by 5 subwaves, which means we are not there yet for a break to the downside, but clearly we could stay sideways for another week or maybe even more. But be aware of
and then one more leg lower afterwards.
Yes.
Yeah?
And also what I like about this triangle formation is actually cycle analysis. Okay, so look here at September in 2017. We have been in a correction for 43 days, okay? And then also this was a consolidation of 43 days before we got a breakdown, okay? So now I'm also assuming that since it's summer, and if the triangle is really going to be the case, we could also stay here consolidating till we get 43 days, which means we have another week left or so. And if you don't believe in cycle analysis, then check this out. We have seen a reversal up from November 07, exactly 71 days, okay? And the following decline from that highs, it was also 71 days. So it looks like that from a cycle perspective, we have a perfect head and shoulders formation that could be forming here. So I really think that we will see a breakdown through this neckline, which holds a temporary support at 1.1570. But as I said, triangle is my primary count since we have seen a failure push to the upside this week. So I think shorts are not there yet, but it could be very interesting once we see prices slowing down for a wave E. Okay, but in the meantime, I think that dollar yen, which is moving very aggressively to the upside this week, I think this should be on a primary list right now. So what I'm looking at here, we make this bigger. What I'm looking at here is a big triangle formation: A, B, C, D, and E. So actually, I'm looking now for a push for further upside into wave D with 3 waves. Okay, I was first expecting a little bit more complex wave B because this was unusual, very sharp wave B. So now, since we are breaking for another day, very sharply to the upside, I think that we are actually stepping into wave C. So if that's the case, there is room to reach this equality level, and also this equality level comes in at this old swing high from November. Okay, so I think if you want to be long dollar, maybe euro dollar is not the best choice yet. So rather look for dollar yen. I'm tracking and will be waiting on pullbacks. So the simple idea is that we are here trading very aggressively higher into wave C. Obviously, there is room for much more gains. Momentum is increasing. So what you want to do is to wait on a correction on a smaller time frame chart. So here I'm observing, I'm just waiting whenever we see a reversal lower in 3 waves, identified here as a wave 2, and this extended lag that occurred this week clearly looks like an extended wave 3. So I'm waiting on price to come down in 3 legs and then would probably look for longs against this invalidation level. So this one is definitely on my rather lose for sure, and we'll just have to wait and be patient till we get an ABC setback. Okay. Also another dollar pair that is interesting is probably Aussie. Aussie is clearly bearish. I'm expecting that sooner or later we will see a reversal higher in 3 waves for a correction, for a bigger one, but based on the shorter term counts, it appears that there is room for more weakness, and actually this 1 hour chart is probably the most clean at the moment. What market did is recovered in 3 waves. Okay, so this was wave A and a triangle for wave B, and then a 5-wave rise for a wave C. More importantly, a drop appears to be quite impulsive, and it also moved below this wave B level. So now when we are moving to the upside, I think that we can be stepping into a corrective price. So watch out for resistance around 74.30, maybe up to 74.40, which is 61.8%. So from there, I'm expecting some kind of a weakness, ideally even in a sharper manner. So from a trading perspective, dollar yen is on my primary list for next setup, and Aussie dollar is also interesting, but I'm more on the side of dollar yen to the upside. Euro dollar also will be definitely very interesting, but as I said, after a completion of 5 subwaves within a triangle range. Anyone there? Steve, any questions do we have?
I'm definitely here. I don't have anything to add.
Do we have any questions?
Yeah, we do have questions, but you go ahead and cover the things you like, and then I'm going to go through questions if there is something that we've been asked for and you haven't already covered it, as I usually do.
So actually, I'm sure that also Dave is wondering what I think about stocks. Actually, if you take a look on stocks here,
stocks keep looking quite nicely. Actually, I mean, S&P has broken out from the descending trend line, and you know, I don't know, but you know, I still have no indication that you know we should be looking lower in stocks. I mean, I had said like
I agree. It's definitely a very interesting recovery this week. But I would still be aware, as you know, I have been highlighting this resistance, which is actually March high for some time, and it's still a very important level where upside could be limited if this is wave B. Because based on the Elliott wave interpretation, if this is really the case, I think that I really should not be surprised by any significant reversal to the downside. I know that NASDAQ 100 is very strong, but if you take a look at Dow, I think that there is even potential. Let me just find potential bearish triangle here unfolding. Okay,
we were talking with Dale the other day, and I was showing him. Do you remember the corrective move lower that we had during the summer of 2015? Actually, exactly 3 years ago. If you zoom out. Go to the S&P. Go to the S&P. I was telling him that I wouldn't still completely rule out. Yeah, there it is. There it is. The wave 4 actually. So I was telling him that I wouldn't still rule out the possibility of another move lower, simply because if you remember, we had that sharp move lower during the summer of 2015, and then stocks started recovering, and then momentum started picking up. And then we almost made it to the previous all-time high, and then we got another sharp leg lower. So I told him that there is still a chance that this recovery is end up going to be a bull trap, and we're going to end up having the same behavior we had during the summer of 2015, trapping people near the highs, believing that the market is only headed higher, then give them one more sharp leg to the downside before actually continuing higher, let's say during fall.
Yes, and I absolutely agree here. I think that investors, traders should be very careful here. And as you said yourself, normally those declines on stocks are very, very sharp, and they will put a lot of fear into the market. So usually when this happens, market recovers, and I still think that this another lack of fear can be coming. Maybe we see it in December, maybe even earlier signs of reversals, but definitely I would be very careful here. If I would try to buy some stocks, maybe I would look for some single stocks out from Nasdaq with good structures, but overall I think that we should be aware of limited upside. Even German DAX still, despite holding that support, if I take a look on DAX, despite that we are trading above March lows, I think that this is a triangle possibility, maybe even flat with another swing low coming, but overall correction appears here incomplete. And you can see where DAX is trading compared to the S&P or even Nasdaq, not to mention this, and it's clearly visible that this is not the real global stock market trend that you want to see if you want to participate on the long side, at least not.
I think the cleanest index at the moment is the FTSE. We got an almost perfect ABC corrective move lower after a very sharp leg higher. Of course, I wouldn't rule out that this is going to end up being like a double zigzag. But if you look at the FTSE, I think that it's textbook, and if it breaks above the bull flag that actually encapsulates the ABC correction, it's going to be looking very nice for more upside.
Yeah, even French index could be interesting.
Yeah, I see it there on the right. Yeah. Do you have the FTSE?
I personally, I was favoring the long side of Australian index because Aussie was very weak. As you know, this is negative correlation, obviously. Because
yeah, obviously, and the nice breakout from a triangle.
And obviously look to buy Australian dollars and vice versa. So actually, the lower time frames charts. Let me just refresh here. Now, why this data doesn't refresh at the moment. Anyhow, on the lower time frame chart suggests that this was just another corrective decline here in three waves, ABC, and looks like that we are now impulsively moving again to the upside. So if I would have to look for some setups, maybe then definitely watch out for markets that are showing the strength. Okay, but
yeah, absolutely.
Dow Jones is definitely not showing that any kind of strength here.
Question, Gregor. What do you think of the metals at the moment? They're obviously, I was saying yesterday once again that, you know, as long as they remain below broken. Yeah.
Honestly, I thought that we will see some kind of a higher, deeper recovery here, and I still think that there could be wave 4 in progress. Maybe it's not going to be in 3 legs. It will be maybe a 5 sub-wave movement like a triangle. But to be this level as a wave 4, while we have previously so complex and very long in time wave 2, it's unusual. So I think that either we see more upside here or at least stay sideways. I don't expect any significant break to the downside, at least not based on this current structure. We could maybe spike to a new low and then turn to the upper side of this trading range that could remain still in play for the rest of the month actually. But overall,
okay. What about crude?
Crude came significantly lower.
Yesterday actually brutal move.
Yes.
And if you see the price action right now there on the 4-hour chart, this definitely looks like exactly like a consolidation that's going to produce one more push to the downside.
Actually, crude had plenty of very sharp turns since start of the month. We have seen first a sharp drop here, then a reversal where everyone thought that we are going higher, then again very strong drops, then sharp rise, another strong drop. So actually it's it's not very clear that we are impulsively bearish, and I would not be surprised if this is just a wave 4 now from basic Elliott wave pattern and impulse. Normally when you see a pullback in 3 waves back into this channel, which is actually called a base channel connected from the lows of wave 1 and wave 2, actually this could limit the downside for wave 4. Also, we are still at the 38.2%, which is very common for a 4th wave retracement. So it would be, for my taste, too soon to say that we are really going to the downside. But dollar strength could really limit the upside here, or at least find resistance. It will be difficult probably, because yesterday when we saw crude oil sharply moving to the downside, at the same time dollar bounced. Okay, so it will be very interesting developments. I said in our chat room also with my members that I would pay attention to 73 level. Probably if we go back above 73 in impulsive fashion, then watch out to buy pullbacks. For now, it's some kind of a do or die zone.
Grega, one question, I think it's relevant, so it's one of the last ones, but I'm going to ask it now. Grega, one question, please. If you wait for a wave C in fall, don't you think there is much room to test the all-time high again? Asks Martin.
On which market?
SPX.
Okay, so if we can retest the all-time highs again. Can you repeat the whole question, please?
Gregor, one question, please. I'm reading it to you exactly as it's written. If you wait for a wave C in fall, I think by fall he means the time of the year fall. Don't you think there is much room to test the all-time high again? I don't think that Gregor said that he expects, Martin, the move lower to unfold in fall. I said that perhaps if we have one more leg lower, we can then recover during fall. So I think you confused what I said with what he said. He just said that he expects one more leg lower. I don't think, Gregor, I don't think that if we do get one leg lower, it can be that much delayed, right? I believe that if we are to get one more leg lower in the indices, in the S&P, for example, it should come sooner than that, like within 1.5 months from now, right?
Yes, by the end of August, definitely we should.
Yeah, that's what I believe as well.
Evidences that we are turning south. Okay, because time will be crucial here for sure. Because if this is an ending diagonal, and if this is really fifth wave, then we are in the final piece here of this pattern. So a reversal should occur, and it could be something similar. If we take a look here, this was a very sharp and sudden reversal, and here from a wave A highs as well, very sudden reversal. So if we are now here in a final fifth wave, then also timing may not be so far away.
Also, we have a question from Gail. I'm now going back in time in the questions. We actually have a couple of people that are asking for USDMXN, but we first have Gail asking for Euro Kiwi.
Euro Kiwi. Okay. Okay, so actually Euro Kiwi, I think it may hit a new high. Okay, because this was quite a sharp reversal from lows.
And the corrective move lower, the move lower is clearly corrective. That's what I was saying yesterday, that the move lower, after getting the day that we got higher, it's now more than obvious that it was corrective, right?
Yes, so if we assume that correction has finished here, maybe as a flat, and if this was an impulse, then let's take a look where next support could be. This is so
from a basic technical analysis perspective, that was a pennant. This corrective move lower, that was clearly a pennant.
Yes, Just a second here. I would label this as a wave A. Wave A, flat for wave B, and I would be aware of a drop lower into wave C. So I would watch out 38%, and also at the same time watch out for this previous correction. This was previous fourth wave. Then you know that this should be very important potential new bounce zone. So for now, I think that we may see consolidation here to look for lower prices and then maybe turn higher at the end of July again. But definitely correction is expected, especially if we consider that market broke out of this upward channel.
Okay. What about USD/MXN?
This one, dollar Mexican peso, is definitely bearish. Just find it here. Actually, it was a pretty nice structure here. If you're, as yourself, you're familiar with the Elliott wave structures, right?
Yeah.
Especially with clear, simple ABC patterns. So this was A, B, and wave C. It was pop up in price for wave C above this channel. But
yeah, a lot of people got trapped there, and a lot of people, you know, this is the perfect storm in my opinion, Greg, and I'll explain why. Because not only we got a move higher that in the untrained eye looked like impulsive, but we also got the Mexican elections, and I was reading like several articles and a lot of speculation that after the elections things are going to be even worse, etc. So a lot of people were also feeling confident that their viewpoint for the currency was also backed by fundamentals, and usually that makes people even more biased. You know what I mean?
Yes, and actually it was so clear wave structure, but the most important is that this sharp is so sharp, this reversal down is so sharp, it's definitely signaling that we are bearish on dollar Mexican peso and that we are stepping into wave C, which means there is room for much more weakness. So I would definitely, yes.
Where's the equality target actually? What is the target of the equality target of A to C? Where does it aim?
Just take a look. 16.4.
Yeah,
there.
A lot lower from here.
If you're trading Mexican peso, and if you are aware of the euro-dollar structure, which means dollar could gain a lot more against those majors, then maybe some Mexican pesos cross pairs could be very interesting as well. Right.
Euro MXN is on support actually because I'm monitoring Euro MXN. Sorry, or am I confused? Let me have a look. Let me open it on my chart because I actually think Euro MXN is, yeah, there it is. Yeah, Euro MXN. If you have a look at Euro MXN, I think we had a fourth wave in a triangle, then we got a fifth false break higher, and now we're back in the triangle and breaking below it. So Euro MXN is definitely a nice setup. You can see it there.
Yes, very extremely sharp drop.
Yeah.
Maybe that current move down came even from a wedge pattern here.
Yeah, exactly. And if you look at oh, you think that was a wedge? Okay.
Very possible. Here was maybe a throw over.
Yeah, perhaps, and the throw over of the wedge. Yeah, perhaps actually. So that might take us all the way down to 19.5 roughly,
or 20 around there. Yes, definitely.
Yeah.
I mean, this reversal is really brutal here.
Brutal, indeed.
Yes,
indeed. And we're currently testing horizontal support at 22. Below 22, actually, you know, things look even more grim.
Yes, but I will definitely, if anyone is want to look for shorts, just wait on pullbacks in 3 legs.
Yeah, and perhaps a retest of the broken trend line, right?
Yes, at 22.75, 22.70.
Yeah, something.
If we see this trend line coming to a test, that's the question.
Yeah. Dale, by the way, do we have an interview today? Are we eating up your time? Dale?
Yes, we have Jim Welsh today, and he's here.
Okay. So, okay, Gregor, we'll be here next week again. So, thank you very much for your input, mate.
Thank you. Thank you, Dale. Thank you, Steve.
Thank you, Gregor, buddy. Wizard of Waves.
Enjoy the interview, Dale. See you all tomorrow.
Okay. All right, Steve. Thank you, buddy. All right, Jim, I see you. I'm going to make you the presenter now. Welcome back to Face, my friend. Just waiting to see your screen, hear your voice. I see your screen. Make sure you're unmuted.
Okay.
I got your voice.
Okay, and
you're showing your desktop right now. There's
okay, can you see?
Yes.
Okay. So
Hi, Jim.
Are you getting? Hi, good morning, Dale. So are we good to go here? I mean,
we're good. Yeah.
Well,
yeah,
that was a lot easier than last time.
Okay. Well, yeah, because you're not calling in, so you sound clear. So your mic is good, and you know what else has been good, Jim? Your work has been spot on. Viewers from investing.com, if you're not familiar with Jim Welsh, make it a point to become familiar with Jim Welsh and his work. I've been following him for decades. So Jim, nice call on the dollar, a couple of nice calls on bonds, and you have some contrarian ideas in gold. So I'm interested in your views, and just take it away, buddy.
All right. Well, thank you for those nice comments, Dale. I appreciate it. As a quick overview, what I attempt to do is combine fundamental analysis with technical analysis. Not too many analysts try to do that. I'm trying to look at the bigger picture, catch the bigger moves, and I think the best way to do that is by combining fundamental analysis with technical analysis. And when it comes down to trading markets, trying to find reversal points, I think there's a lot of people believe that markets are a discounting mechanism, and you hear that over and over again whenever you listen to TV or even if you read articles and so forth. And honestly, for the most part, I think that's complete hogwash, because if you just look back at various turning points in markets that you have traded yourselves or can remember, the NASDAQ in 2000 when it was above 5,000, what was it discounting for the upcoming year or two? It was not discounting an 80% decline. In 2007, in October, the Dow and S&P made two all-time highs. What were they discounting? They were not discounting a financial crisis. And of course, at the bottom in March of 2009, when it looked like the sky was falling, they were not discounting that we were just about to go into the second longest business expansion in the history of this country. So I really believe that everyone buys into that. It's logical. And as human beings, we embrace logic almost more than anything else. It's like our little comfort blanket. But at turning points, what typically happens is sentiment becomes extreme and positioning becomes extreme. And it happens because when markets trend, slowly but surely, everyone learns the reasons why a market has been going up and down. They finally get it. They then position themselves to take advantage for the trend to continue. And what typically happens is most people are too long at tops and either out or short at bottoms, and they get run over.
Wasn't that one of your biggest factors for seeing the highs in the euro, about 124, 125? Because I didn't see a lot of technicals. It could have been, consolidation instead of distribution, but the extreme positioning on the euro, the extreme bullishness was a big part of your thesis on that position.
Yeah, absolutely, Dale. I mean, you had over 90% bulls. If you looked at the positioning, the large speculators had their largest long position ever. And then from a pattern analysis standpoint, the prior folks who were on, we're talking Elliott wave. I think Elliott wave can be useful. I jokingly say it's useful about 1/3 of the time. And then 1/3 of the time you have 2 or 3 options, and 1/3 of the time you might as well just flip a coin. From the euro standpoint, from its low, and we'll look at the chart in a moment, I think you could count 5 waves up. So that kind of implied at a minimum you were prone for a pullback. So yes, Dale, given the sentiment and positioning, that was a main reason why I thought the dollar was going to rally, because the euro, I'm sure everyone knows, is 57% of the dollar index. So we'll just jump in here real quick in terms of looking at the positioning. We're going to look at bonds real quick, and then we'll skip to the dollar and go to gold. In the bonds back in January of 2017, you can see bonds had been declining from the July 16 high, so they had fallen fairly significantly. Bond yields had ticked up from 133 to 260-ish. But looking at the positioning, the red line out of the commercial specs, and as the bond market really started to bottom out, the commercials went really long because, you know, this big decline. Large specs is, aha, okay, rates are going up, I'm going to get on the short side. And so my position was it was time to buy bonds because I felt they would retrace potentially 50% of the decline, and they could rally to 128 to 129 on TLT, which we'll look at in a second. By the time September came, lo and behold, you saw the positioning completely flip-flop. The commercials dropped significantly. The large specs jumped on the long side. I felt bond yields were poised to rise, and that we would see on the 10-year it getting above 260, making a run at 3%. That was a high back in December 2013. And, you know, it took a little time for it to really develop, but in earlier this year, it got going in earnest. At the low here in May, again, you can count 1, 2, 3, 4, 5 down. I felt this was a time, to cover short and then go long, because I thought at a minimum, we would rally back to wave 4 of lesser degree. And looking at the positioning, the commercials got very, very long. The large specs short over 500,000 contracts. So this is one market that, looking at the positioning, can be very constructive. What's interesting is you can still see the commercials
still pretty long.
They really are 668,000 contracts, and the large specs are short. So
so you're going against that because you're looking for a pullback in the bond market here, aren't you? Short term.
Well, what I was playing for, Dale, was, and I'm going to jump to TLT here real quick, is the idea that you had 3 lows in terms of yields, 3 highs in terms of TLT, all within very, very short distance of each other. On the 30-year bond yield, 295 and change were 2, and then most recently. So to me, it was like, this is the perfect place if one wants to go against the grain. You've got a place where you can put a stop less than 1% by going short and, you know, having a tight stop on it. And I tried that and got run over last Friday on the jobs report. It was stronger than expected, and yet bond yields came down. But we're at a very important point, because if TLT can get above this, I think it implies that we're going to see bond yields stay low for a longer period of time. So to me, the bond market's had kind of
I was kind of thinking, would 128 be a viable target if that's the scenario in TLT?
Yeah, okay. I think so.
All right.
So going back up to these levels here, these notations
kind of a measured move from the low to the resistance, and above it gives you about 128. Yeah. 116,
116.50 to 122. You're at 100% right, Dale. So this is where I went long on TLT, recommended that, selling, then got short. As I said, that trade took a while to develop. It was really frustrating because the 30-year just refused to tick up, and then finally they sold off. And when positioning got very extreme in February, it was time to cover the short. I bought, looking for a move up to here. So this has been a very easy market actually to trade, looking at positioning and just the chart analysis. We're at an interesting juncture because on one hand you have cyclical inflationary pressures that I think are in fact building. Things like the PPI yesterday, I didn't see the CPI yet this morning. Wage growth is actually picking up despite the labor number that came out last Friday. But countervailing that is the tariffs. On one hand, yeah, they're inflationary too. But on the other hand, look at what we're happening in commodities across the board. So that's really a whiff of deflation that's going on there. We jump to the next one in terms of the euro, as Dale was talking. Back in December of 2016, the commercials were very, very long. The euro dropped from what was it? I don't know, 138 or so. It was
140-ish. 140-ish.
Yeah. Okay. And I was very bearish back in 2014.
I remember.
I thought and thought the dollar was about to rally from 80 up to 95, maybe 101. And it was really based, I won't go into the details analysis, that Mario really had not much to do other than pull the lever of a cheaper currency to try to get inflation going and so forth. So here you can see 1, 2, 3, 4, 5 for 3, and then a 4, 1, 2, 3, 4, 5, 4, 5. So to me, this is why, pattern-wise, there were divergences as this was going on up here. So the technicals were kind of aligning. And look at what the large specs were very short at the bottom. And then as the market went up, they got really pretty long, an all-time record long position, and the commercials will take in the other side.
So what do you do when all these COT numbers compress to zero like they are now?
Well, to me, what it looks like is you got 1, 2, 3, and this might be 4, 5. It may be over, or the euro could be doing a triangle, A, B, C, D, E, and then one more shot down. So this kind of congestion, I personally, would rather sit on the sidelines and wait for this stuff to sort itself out. I mean, to me, from a trading standpoint, Dale, what I want to catch is this move, wave 3s in the world. So if I can get in near the low of 1 and then get the extreme move, because typically wave 4s, it's going to be a retracement against you. And if it develops into a triangle, now you're talking about a lot of time. And, that just gets frustrating. So to me,
so it's a stand aside to you. Would you be a seller at 120?
I would be more a buyer if it goes down and makes another new low, because then I would feel very confident that, or more confident, I should say, 1, 2, 3, that this is a triangle. Oh, you get a spike down for a 5, then I would be more inclined to take a position in anticipation, looking for a move back up to 120. So, the positioning is improving. You can see the commercials, and they're all, like you said, they're coming to the zero line.
They're neutral.
Across. Yeah.
Just like the market's neutral, the positioning's neutral.
Exactly. So in those kind of markets, I just think, hey, it's more headache than worth, trying to play that game. So again, the idea here is to catch intermediate to more important turning points. That way, even if you're trading on a short-term basis, if you can identify these major turning points, and you're trading for the next 2 or 3 days, it's nice to know which direction the tailwind is, and that if you're going to do a short trade, you better be careful along the way, to have very close stops, because the tailwind is in your favor. And I think that's where this intermediate type analysis can be very helpful to short-term traders. It's like seeing the forest from the trees. And I think it's very easy to get caught up, you know, in the trees. All right, here's the dollar index. As they were saying back here in February, again, you could count from the January of 2017 high, and I was bearish the dollar at that point in time. It had completed, you know, what I thought was 5 up. It was prone for a fairly good-sized pullback. Sentiment was 90% bulls in January of 2017. And I also thought that we were going to see Trump make some comment bearish the dollar. And he didn't even wait until he was inaugurated. I think it was January 9th. He came out and said, you know, in theory, the dollar's, a strong dollar is good, but in reality, it really isn't. So anyway, from that January of 2017 high, you could count 5 ways down here. So it's like, okay, we're completing something here. And the positioning, so that chart-wise said, all right, we're near a low. You know, now it's just a question of, are we going to make one more new low or not? But the positioning was very constructive. Again, I don't have, we showed the positioning on the euro. So I was looking that the dollar would rally based on a decline in the euro, since it's 57% of the dollar index.
Okay, so based upon what you said, based upon Jim, based upon what you said in the euro, so this would be a non-trade too, and you'd be more willing to short it at new highs up around 96 than look for it to go to 92 and then buy it.
Yes.
Okay.
Yeah, because again, if the euro's in a triangle and it has a thrust down, that should lift the dollar index back up to this 95.53 high. This is cash that I'm showing.
Right. Okay.
And you know, so
clean out the stops for a third drive, maybe.
Yeah, one of your favorite. Chart,
you know, besides 1.618, is there anything I like more?
Nothing more than a third drive. You know.
All right.
And for good reason. It works. I mean, it shows up, with a frequency that's not paying attention to that, and then potentially, if it fails, now you got potentially a little bit of a head and shoulders.
Right.
The dollar dropped 180 basis points. Through yesterday, it retraced about 80. So it hasn't quite done a 50% retracement as of yesterday. So it may go up a little bit more. It may just simply be, hey, this is the first leg of the first correction. That's
what I think.
A rebound, and then going down again. That's been my bias.
Yeah.
That's been my bias.
But I could see both. You always have to see both. So you know where you're, not a bad risk reward getting short on this fib retrace up here, wrong over the double top, something like that.
Yeah.
So what are you doing in gold here, buddy?
Okay. So again, gold positioning back in July of 2016, you can see in December of 2015 here, the lines got really squished. The large specs were pretty negative. Things like managed money, the blue line on this one down here, were net short, which is, they don't do that very often. All right. So I was very bullish on gold here and looking for, a pretty good sized move. By July of 2016, the positioning was, extreme. Everyone got bullish. They knew why gold was going to keep going up. And this is another point. When gold got to 1900 in September 2011, what was it forecasting? Hyperinflation or a decline from 1900 down to 1040? So again, the idea of the market being a discounting mechanism is a joke. Contrary opinion is far more powerful and a much better aid to trading markets. It's hard though, because you're going against the grain. You're picking up the newspaper and you're reading every day why markets are doing whatever it is they have been doing. And that's why I think looking at positioning, looking at technical analysis can help provide enough conviction to go against the grain. So in this case, I thought gold was topping. It was going to do a fairly good-sized correction. As we got to the low in December 16, I turned bullish again because, again, the positioning got very constructive. Sentiment toward the gold got very negative. Again, I think you were down to 10 to 15% bulls. So every time these things have pinched down where the large specs get squeezed out, here's a good case in point. It took out the prior low, cleaning out all the stops, And if you were bullish, you know, a trend line connecting these lows, this decline took you out. And I have felt the last couple months that that's what we were going to see in gold, that if you took a trend line connecting this low to this low,
yeah,
all of it, I thought, you know, it would
1280
walk out
breakdown. Yeah.
Yes. Okay. And then there's a trend line from here to here that got taken out. So progressively, what's been happening is, I think, you know, again, people are looking, expecting inflation to come back, but gold isn't responding. And as we take out each one of these trend lines, look at what's happening. Large specs are getting more and more discouraged. If you go back the last 18 months, we're in the second most constructive level in terms of large specs not being long. Commercials, their short position is the lowest since July of last year, which was followed by a $130 rally. The managed money I mentioned before, they are now net short 1,254 contracts. The last time that happened, way back here in January 11th of 2016. So the positioning is constructive. Sentiment, there have been a couple weeks or over the last couple of weeks where you've had less than 10% bulls in gold. So what I discussed in the Monday weekly technical review was looking at, like, you know, a 30-minute chart of gold, and you had an ABC up to the high at 1265 recently, which implied we're going to go back down again to make a new low. And we got close yesterday. I think potentially gold still has the potential of dropping down, but I would not be short this market because of
silver made a new low, Jimmy, by a penny.
Okay.
Gold held the previous low by $4. So and the gold shares have been acting better. They're not making new lows. So
yeah,
so how much upside are you looking for here? I know you take it day at a time. It's always a process, but what's your vision on this?
Well, longer term, I think potentially Dale, gold went from 1920 to 1040 in December 2015, a decline of $880. I thought the rally up to the July 2016 high was wave A, and that we've been in some kind of a wave B, and that ultimately gold is going to go above that high and reach, you know, 50% retracement of that 880 decline. 440 added to 1040 gets you 1480. So I think we're going to see gold go above 1400 before the end of the year. You know, short term, first gold has to bottom and reverse. Number two, you know, obviously this is going to be a zone of resistance up and through here. But if and when it clears 1370, it's going to be a sprint, I think, about 1400.
Oh, yeah.
This is the longer term view. So we're coming down and attacking this line, connecting the December 15, December 16 lows. It wouldn't surprise me to see a brief, again, cleaning them out. You can see the RSI at the bottom here. This is a weekly chart. So the RSI as of yesterday was at 33. This is the lowest it's been since December of 16. So again, the technicals are getting extreme. You mentioned the gold relative strength of the gold stocks to gold. This is that ratio. You can see, here's goes back to last September. A week ago, we broke through it. We weakened again yesterday a little bit just because the gold stocks got hit pretty good. I've been looking to be a buyer under this low here, which is 2180. Well, the low is 2177 on the GDX, and ideally seeing the RSI get down to 35. So I think there's the potential of a very decent move in gold, 10 to 12 to 15% up. That's what's happened the last three times the position has gotten this constructive, and typically the gold stocks will do double that. One thing I wanted to touch
it's
on,
definitely, you know, it's definitely a contrarian call, Jim, because, you know, up until maybe a month ago, you didn't hear this. I mean, everyone was anticipating a 1360 breakout when it was knocking on the door up there. But since we've had this decline, you know, the $1,000 gold, $800 gold bears, deflationists. Even some guys that I know are pretty good are saying, you know, 1120. So, you know, the bears have really come out of there's no one that is saying buy gold right now.
Yeah. Well, I mean, again, you know, two things. My July,
except, you know, unlike you, Peter Schiff and Kitco are always buying gold.
Well, I refer to Peter Schiff as Peter Trill. So he's one of the few people that I can honestly say I have very little, no respect. I find him annoying and obnoxious, and he's more often than not wrong. So other than that, he's a wonderful fella.
Yeah. Where do I sign up? Yeah.
Yeah. So
is
you're
that
100% right.
Yeah.
About, everyone was getting bullish 1360 is going to break. But again, looking at the positioning, I saw the commercials shorting into those pops, attempts to get up there. And that's why I thought we would see that progression of taking one trend line out after another, just gradually beat the longs up and get them squeezed out. And I think we're just about there. But the July commentary, the title was Cyclical Inflation followed by Deflation. So I think deflation is coming, but it's not coming until we see a meaningful decline in economic activity. And, sooner or later, the Fed always raises one too many times. And when that happens, given the amount of debt, not just in the U.S., but debt to GDP ratios around the world are like the highest ever. So you got a meaningful slowdown in economic activity. Debt is going to become a real problem. And I don't believe the central banks have the same tool bag as they had in 2008. The Fed can't keep the Fed funds rate from 5.25 to 0. The Fed can launch another QE program. I'm sure they will. I just don't think it's going to be successful. When you look at the debt going from 9 trillion to 20 trillion, the Fed's balance sheet going from 900 billion to 4.5 trillion, and you look at how much it added in terms of GDP, it wasn't much of a bazooka, to put it that way. So I think deflation is the biggest risk going forward. Now I'm going to show you a chart. This is the Bloomberg commodity chart, and from the 2011 high. So in 2008,
it's my initials. It's my initials.
It is. So
TJP.
They were thinking of you.
I'm famous.
So the 2008 high was up here. Okay, so that's like from a big picture, 1 down, 2 up. But from the 2011, you can count 1, 2, then wave 3, 1, 2, 3, 4, 5. So since the January 2016 low, it looks to me like, hey, it's trading out a big triangle. And triangles are always a pain because you never know. There's always going to be one more leg. So potentially, this high right here about a month ago could be wave E. It also could be wave C. In other words, A here, B, C here. We're coming right down to this trend line connecting the January 2016 low, July 2017 low.
Great look.
So it could be A, B, C, D. We get one more, uptick, and then turn out the lights. All right. Obviously, it's very oversold on a weekly basis, and so forth. But to me, this pattern looks like a triangle. It does not look like inflation's about to break out. And if we look at the shorter term picture of it, it's a little bit more clear. A, B, C for B, A, B, C for C, and that's why potentially C may have peaked here, and now we're in D. But yesterday we closed right on the black line. The blue line is just a little less aggressive in terms of the ascent line. It's very oversold. You've got some divergences on the RSI, so we maybe do a bounce. But to me, this is really worth watching because if we are about to have deflation, that is something that no one is looking for, and in the short run. And I think this would provide a clue that we're maybe headed that way. Clearly, the tariffs and what they've done to grain prices and so forth. And, people minimize, you see, that, well, it's only $32 billion of additional, tariffs, and as a percent of GDP, it's infinitesimal. I get all that. But what they're not capturing is the knockoff effects where, company CEOs are looking at what's going on, and they're sitting and saying, you know what, maybe that expansion plan, let's wait a little bit. And so I think there's the subjectivity of not knowing how this is going to go. It's going the wrong direction. That's all we know so far. And I think it's causing some people to pull back. And that's what I stated in my July commentary. And the minutes of the Fed last week when they came out kind of said, yeah, they're talking about it. They're getting feedback from corporations that they're holding back on stuff. So when you hear
you know
the
what
numbers,
they're not holding back on, Jim? Buybacks is what they use the tax savings for. Buybacks.
Yeah, I mean, that was the biggest joke, if you will. I mean, it was so easy to read. In 2004, they had the Homeland Investment Act. I mean, oh, isn't that a wonderful title? But 90%, over 90% of the money went for buybacks and dividends, even though in the law, it was expressly stated you could not do that. So to me, this was an instant replay. Now, Japan did a tax cut for corporations, but they had a stipulation. You could only do buybacks if you gave your workers a wage increase. And, you know, to me, that's a probably intelligent thing, because big picture here, over the last 30 years, from the mid 80s, we've seen a pendulum shift away from corporate America and corporations in general from being good citizens, making good products, and paying their workers a decent wage. They've shifted to maximizing shareholder value is the preeminent factor that's guiding most decisions. Personally, if you look at, you know, profit margins are at an all-time high, wages as a percent of GDP are at a 50-year low. And Henry Ford had it right. I'm going to pay my workers enough so they can afford to buy my cars. Sooner or later, and I think it's going to be when we go through what I think is going to be a very difficult time in the next 3 to 5 years during the next recession, I think there's going to be such a backlash that companies are going to be forced to kind of swing the pendulum the other way and start increasing wages, because ultimately demand drives economies more than anything else. Not government spending or anything. You need demand, and you need to pay, you know, better wages. And then unfortunately is not their focus. Instead, they borrowed trillions of dollars. There's more debt as a percent of GDP on corporate balance sheets today than in 2007. And so we're seeing, you know, the worm turn here. There was a piece in the Wall Street Journal in the last few days that companies that have been buying stock, their return on investment is the lowest it's been since 2011, and the stocks where their buybacks are the biggest are underperforming the S&P. So,
interesting.
You know, I think, I thought
it's kind of like the QE. After a while, losing its effectiveness. This is the same thing. Buybacks are not having the same type of positive effect on stock prices as they did. Just like QE stopped, really every dollar you spent, you were getting a lower return on QE too.
That's right. That's right. And so, you know, to me, these are some of the things that, you know, I like to write about, and because at some point in time, they're going to become very important factors, and the majority of people are not going to see it coming. I believe that the next decline, you know, when we get into the next recession, I think the market's going down by more than 50%. Again, it's overvalued. The leverage built up in the system isn't the same way as it was in 2008, but the tools to battle the next recession, not just from the Federal Reserve, but central banks around the world, are far more diminished. And I think, you know, what will happen is you'll have a leg down in all the equity markets. Central banks will ride to the rescue. Everybody's, oh yeah, look at the last time that worked out great. There'll be a heck of a rally. And then the reality is this isn't working. And that's when it's going to be really ugly. And the social divisiveness that we're seeing, not just in the US, but around the world, I think is going to get magnified because when economic hardship befalls a lot of people, they react very negatively. And I think that the social divisiveness is likely to become far worse if this plays out. So, we're headed.
Jim, I hope I'm on my Haven Island paradise watching it all on TV, and you're welcome to come and hide out with me, you and your family anytime.
Well,
okay.
I thank you, and hopefully we're short because that'll be making opportunity. You know, so,
it will be. There are once in a lifetime type thing.
Yeah, kind of a little bit like 2008. You know.
Yeah.
So, you know, this is. I mean, central banks went on an experiment that's never been done. They were forced to do it. And you look at where bond yields are, and in Europe especially, there's a big adjustment coming.
Let me ask you
in the
this.
next 6 to 12 months.
I'm guessing with what's happening in Europe that they're the epicenter this time, Deutsche Bank, Italy, everything happening there that,
Yes.
ground zero is not here. Europe has more problems, then it goes to Asia, and we're the last domino.
Yeah, I think,
What do you
I'm
think?
glad you mentioned that, because I agree. I believe that since the last two big declines were initiated, if you will, in the U.S., the dot-com bubble in 2000, financial crisis 2008, that the next one is more likely to start overseas. Why? Because it'll probably catch most people by surprise. Oh, our banking system is really, really strong, so on and so forth. In Italy, I'm glad you mentioned it, their debt to GDP ratio is around 135% or so. There's no way they're going to grow their way out of it. Their GDP is barely above where it was in 2000. So the last 5 years, they have failed to make a lot of structural changes to labor laws and the way business is done in Italy. And so they've wasted the last 5 years. And the net result is, growth really continues to be quite poor. So they are definitely one of the candidates for a problem. And of course, China. And then last but not least, you have geopolitical tensions that I think will continue to build between the U.S. and China. And, who knows how that plays out. The Middle East is another issue. So there's a lot of candidates. But the debt to GDP ratio is going to be what drags, I think, the global economy down during the next time we have a recession.
Jim, great interview. And I encourage people to take Jim up on his offer, get a free issue of Macro Tides, and there's all his information. You can follow Jim at Jim Welsh Macro on Twitter, and there's his email address, jwelsh@smartportfolios.com. Great look and great discussion. Really appreciate you being here, Jim, and I look forward to continuing to read your excellent work every week. So thank you, my trading warrior brother. You're very welcome, man.
All right. Hey, thank you so much, and thank you to all who took the time out of the day to listen in. I appreciated the opportunity to share my thoughts and analysis. Have a great day.
Okay, good hunting, Jimmy. All right, everyone, that's a wrap here. All right, bro. All right, that's it. So remember, everyone, don't just count your pips, count your blessings. We'll wrap up the week TGIF tomorrow. Appreciate investing.com being with us. You're very welcome, Kareem. And see everyone tomorrow. Enjoy the rest of your day. I'm rooting for each and every one of you. Adios.